Indicators like the yield curve, high yield spreads, and consumer confidence are flashing warning signs of recession, and we now estimate a 50-50 probability of a U.S. recession over the next 18 months. Importantly, we think any recession is more likely to be of the shallow, cyclical type as opposed to a deep structural recession. Let's take a closer look. Growth data in the U.S. has been generally solid, including critical areas like consumer spending and capital expenditures. Nonetheless, gross domestic product in the first quarter fell 1.6% due to weak exports and declining inventories. Some models see zero growth for the second quarter, which would meet one technical definition of a recession. For a full-blown recession to take hold, we would expect to see much broader declines in economic activity, especially in areas like the labor markets and capital spending. Inflation remains top of mind for investors as U.S. inflation hit a higher than expected 9.1% year over year in June, the second consecutive negative surprise. While core inflation, which excludes volatile energy and food prices, has declined sequentially for 3 months in a row, the rate of decline has been slower than market expectations. However, there is a real conflict between the current high level of inflation and what the market is pricing in for inflation over both the near and long term. Expectations for inflation over the next 2 years have dropped from a peak of 4.9% to 2.9%, and market expectations for inflation longer term, roughly the years 2027 to 2032, have declined to just 2.1%. The second order effect of inflation on growth is increasingly of concern to investors. More globally, we continue to focus on Eastern threats as a primary risk case. We have been more cautious on European growth due to the impact of the Russia-Ukraine war on activity and the increased uncertainty about European energy supplies. Chinese growth has also been disappointing, with a continued growth drag from COVID-19 in China, leading to some increased fiscal support in recent months. In response to our more cautious economic outlook, we made another change in our global policy model this month as we reduced our recommended position in natural resource equities by 2%, allocating the proceeds to cash. Overall, this leaves the global policy model modestly underweight traditional equities, modestly overweight real assets, overweight high-yield bonds, and underweight investment-grade bonds. Market volatility is likely to remain high until clarity is reached on the Fed's rate cycle and the resulting impact on economic growth.